I'm Dan with Model Mortgage and have Anthony can still not say his last name with Uqual. And Uqual has been a valuable partner for me since I learned about them about 8 or 9 months ago.
Well, Dan, thanks so much for the invitation. It's been a pleasure working with you and the folks over at Motto Mortgage. My name is Anthony Iacobucci. I'm the National Director over at Uqual. What I'd like to show you guys a little bit today is some basic credit knowledge that I think it's relevant not only for a mortgage professional, for a real estate agent, but even for a person who's just looking to have a better understanding of exactly how credit works. So there are some things I'd like to touch upon, the do's and don'ts of credit during the pre-approval process. So what you're looking at right here is just some of the basics where there, quite frankly, is oftentimes a lot of misinformation out there in regards to consumer credit. The first bullet point I'd like to touch upon is where to maintain your credit card balances. 30% of your credit card, 30% of your credit score is predicated on your balance to limit ratio on a credit card. And I'll start with this. If you are operating without a credit card, if you do not have a credit card open, regardless if you don't like them, if you've misused them in the past and you're not comfortable using them, 30% of your credit score is based upon do you have revolving debt open, i.e. a credit card. So if you are operating without a credit card, that's like saying I'm going to take a test today and say the best score I can get is 70%. In regards to where the score can be optimized within this 30% bucket of your consumer credit score, the balance to limit ratio for the Fannie Mae Freddie Mac FICO algorithm is 6%. I've heard under 30%. I've heard under 50%. I've heard some people saying you need to keep really high credit card balances because it seems like it'll show the credit bureaus that your active usage month over month. When Dan pulls your credit, you want to make sure your balance to limit ratios on your credit cards are below or around 6%. It doesn't mean that you can't continually use them throughout the month. Doesn't mean that you can't max them out and pay them down. But optimally speaking, when you're looking to get pre-qualified for a mortgage, you want to have your credit card limits balances below 6%. I know the next point I'm going to make might sound very, very redundant, but I want to understand you understand the impact. Over there, paying things on time is imperative. I've talked to so many folks over 14 years of doing this. I'll get caught up next month. I'll make a double payment next month. Oh, it's only one 30-day late payment. I've been paying them on time for years. A 30-day late payment can cost you upwards to 100 points on your credit score. So do everything you possibly can to make sure that you're paying things on time. When I say trade lines paid, I'm talking mortgages, auto loans, credit cards. Please make sure that you are paying them on time, month over month, continually. Very, very important. Also during the home buying. Oh, Dan, please.
So, and this is, I guess, just me to see if I'm giving the right advice. So we have folks, I'm one of them that want to use, my credit card at the gas pump, etc., to get my points and all that good
Yep.
stuff. So that one goes up. Um, But if you wait for the bill to come in, my ratio's off. So I've been advising folks to, set a calendar and pay that down before the bill comes in.
Yes. So that's really, really good advice. Because here's a little trick for you. The credit card companies understand that the algorithm scores your balance limit ratios. Understanding that human psychology, that most folks do this, right? My credit card's due on the 15th. I've either set a reminder for myself on the 15th or do an automatic ACH from my checking account to my credit card account on the 14th. But what the credit card companies are doing is that they're reporting those balances to TransUnion, Equifax, and Experian, the repositories, a few days earlier, maybe the 9th, maybe the 11th. The credit card company has to disclose that date to you. It's just in the fine print of an application that nobody reads upon applying for a credit card. So the advice I give to a lot of our borrowers is flip over the back of your credit card, call the servicer, ask when they report the balances to the credit bureaus. If it's the 8th of the month, then instead of paying everything on the 15th, even though the 15th is the due date, make sure you're paying everything on the 7th, because next time your credit report will report, will be with a lower limit, a lower balance, and maximizing your opportunity, your credit score. Good question, though, Dan.
No,
Um,
thank you. And good content.
yes. Um, when you're in the midst of the home buying process, you need to mitigate or stop completely on pulling your credit, whether it's applying for a car loan, whether it's applying for a credit card. The inquiries are going to cost you 2 to 5 points on a hard pull. A hard pull is anything that you're doing that's going to obtain financing, whether it's a car, whether it's a credit card, whether it's a mortgage. Anything that you do online is a soft pull. It will not adversely affect your score, but it not only will cost you points in your credit score, but then Dan's going to flag it because it's a new trade line, it's a new debt. It could throw off your DTI. So when you're speaking with a mortgage professional like Dan, when you're getting pre-approved, the first advice he's going to say is you're on a spending freeze. Do not open up anything. If you need to, consult a professional. I understand life gets in the way. Sometimes a car blows up. You need to get a new car or a lease runs out, so on and so forth. It oftentimes will have a deep impact on your pre-approval process. Um, and then lastly, what I'd like to address is that closing accounts sometimes is a sneaky way of losing points on your credit score. And I've talked to so many consumers where they said, hey, before I sit down with Dan over at Motto, I'm going to close all of my outstanding accounts because I want to be debt free when I talk to him. But what you're doing is closing all of your good accounts, losing all of the payment history. The algorithm is not going to pick up length of history, which is a 15% component of your credit score, once the account is closed. So do not close accounts. Oftentimes it has an adverse effect. It actually sometimes makes your score drop because all the good payment history that you might have had on a credit card that's been open for 4 years is now gone. So very sneaky mistake a lot of folks make. The
Yep,
next
I
thing I
talk
would
about
like,
that one a lot, right?
yeah,
You pay off that car because if that's the only thing you got, guess what? That's good. You paid it off, but you also got rid of your payment history.
listen,
So credit cards, unless it's charging you a stupid yearly fee, keep it open. And nowadays, because creditors with the amount of debt that's out there, if you're not using your card, they will close it. So
yes,
use the card at Starbucks once in a while to keep it
yes.
active. Just don't let the balance go up.
You do not get the points from your credit card if you're not using it monthly. And everyone says, well, listen, I'm paying it off monthly. There is a big difference. Dormancy is a real thing in regards to credit cards. If the algorithm does not pick up a payment, a charge, you do not get points. So if I have a $500 balance from November and all I do in December is pay that $500 balance down, I'm not maximizing my points. I need to make a charge. Now, it doesn't have to be a grandiose charge. Yeah, but you got to buy a cup of coffee, fill
Mm-hmm.
up a gas tank. You have to make sure you're actually making a charge on it as well. The
No, perfect.
next,
I wanted to
yeah,
hit that. So
yeah. The next slide is going to be where predominantly most of the impact from derogatory information impacts the credit score. And this is the adverse effect of collections. What I like to say is an old saying that we have here at Uqual is a collection is a collection is a collection. A $10,000 collection and a $0 collection, both reporting in the month of December, will adversely affect the score at the same rate. Monetary debt, monetary value of a collection does not affect your credit score. What does is recency. That's why I said if there's a collection for $10,000 in December and there's a $0 paid collection in December, they both affect your score at the same rate. And the consumer's like, mind's blown because it's like, well, I owe someone $10,000, but I paid somebody off on this collection. They're both affecting me at the same rate. Yes, the outstanding debt affects your DTI, but first base of a transaction is, do I have the qualifiable threshold credit score to get the pre-approval? And paying collections sometimes has the adverse effect because all it does is brings everything current. Recency will drop that credit score
brings it
and
back
you
to
will
life,
not,
I tell them.
It does. It revives the activity, which is the date of last activity, and your score oftentimes drops. So unless you're getting that account deleted, which is a specific methodology that most folks do not know how to do, it's called a pay for delete. It is not in best practice or best advice without consulting a mortgage professional like Dan or a credit specialist like me on just paying outstanding collections because it might send your credit score spiraling in the wrong direction. So, good piece of information to understand there. Any questions on that one, Dan?
No, I'm good. And Eric, if you have any questions, I know it's just us. Feel free to jump in, please.
Yeah, please.
But I'm saving chunks and nuggets out of this. So
Yes. This is a really impactful slide because most folks that have marginalized credit or only really keep their heads wrapped around it when they're doing something big like getting pre-approved for a mortgage. But this shows the impact right here of having marginalized credit. I think the biggest one is right here, and I'll use Dan as an example. Let's say, and this is based upon a 620 credit score relative to a 720 credit score. Let's just say Dan and I were next door neighbors. He's got a 720 credit score. I have a 620 credit score. We both get the same exact car, same color, same sunroof, same electronics. It's a $22,000 loan that we each get. It's a 60-month term, which is 5 years. But Dan's getting it at a 720 credit score. I'm getting it at a 620. Over 5 years in interest and fees, I will pay an extra $9,940 over the life of that loan, which is crazy. When you start hearing cliches like financial freedom or financial wellness or predatory lending, this is what they're talking about because a 100-point difference in your credit score is going to be $10,000 worth of interest over 5 years. On top of that, in some states, your credit score has a bigger impact on your car insurance than your actual driving record. In this example right here, the 620 to the 720, I'm going to pay an extra $1,000 a year in car insurance because my credit score is lower. So imagine the same car that I have is the same car that Dan has, 720 to 620. Over 5 years, it's going to cost me $15,000 extra in interest and fees. Think about what that money can be spent on: family, retirement, down payment. That's just all extra interest that's being toppled on. So
that's $250 a month.
it's crazy, right? It's crazy. And then this right here is people with below a 580 credit score. So folks that Dan might have that Dan refers on over to us that are not pre-qualified because the credit score is not at the threshold. Look at the difference between a 580 to a 760, which is going to be super prime, where the premium rates and products reside, relative to someone at a 580. Everything is you're paying double in everything. A $10,000 personal loan is going to cost you $5,000 in interest. And a lot of people have to get those. Yeah, Dan, I'm sure you see them on the credit report all the time. Those one main accounts for 10 grand, that people need to stay afloat. You're telling me that if I borrow $10,000 from you, 3 years later, I owe you 15,000. It's crazy. It's crazy. And look at a credit card.
That's Goodfellas type money right there.
It is. It is. It's legalized loan sharking.
Yeah.
And then all the way on the far right is going to be a credit card. $5,000 worth of credit card debt can be paid off through the interest rates through super prime, $2,200. It's going to cost you $7,000 making minimum payments on $5,000 worth of credit card debt with the rates that you get below subprime, excuse me. Crazy. The last thing I want to address, which is highly educational. I know a lot of folks have it out there. Why is my Credit Karma score higher than what Dan over at Motto Mortgage is going to pull? First and foremost, stop using them for an accurate depiction of where your credit score is at. Fantastic for I think it's a great product for monitoring or just getting a snapshot of what your credit report looks like. But from a score perspective, it is not even close. Okay. What you're looking at here is the Vantage scoring model, what Credit Karma uses relative to the Fannie Mae, Freddie Mac, FICO algorithm. I want to put attention towards the 4 bullet points at the bottom. Credit Karma reports that information, but it does not score it. For example, I think the most egregious one, Dan, is going to be medical collections. About $100 billion worth of medical collections at a credit bureau level. So it's probably the number one impacted derogatory account on consumer credit scores. Credit Karma does not score medical collection. So they're saying right off the bat, we're taking $100 billion worth of collections off the consumer credit table, not going to hold it against the consumer. Next, Credit Karma is only a snapshot of what's happened or what's transpired in the last 2 years. It'll show you what you did in 2018 and 2017, but you're not being held accountable for it. As you know, right? If there's late payments on a consumer credit report from 2019, the consumer's credit score is going to be compromised. You guys look at everything in a 7-year window. The other big differentiator between the two, Credit Karma says your balance to limit ratio should be below 50%. As I alluded to in the first slide, 6% is the optimal number. Credit Karma said, listen, if you're carrying balances below 50%, you're doing a good job. As we all know, that's not the case. And then lastly, collections under $100 are paid. Credit Karma is always encouraging the consumer to settle and pay those. We know that has an adverse effect on your credit score now. Touching those collections is not a good thing. So really, really important stuff. That slide is fantastic. Dan, what question do you have for me?
So not a question, but I know when I talk to folks when they talk about, the Credit Karma versus this is obviously the model we pull are different. But here's what Credit Karma is good. If that score goes up, chances are your FICO goes up.
Yeah,
If that score goes down,
a good
chances are your
indicator. Yeah.
FICO goes down. It doesn't give you an actual range of what the score is, but it is a good free tool to monitor if you're making improvement.
Yes, agreed.
So that's kind of the way I
Um,
explain it.
yeah, no, it's really good. But oftentimes, I see it just sets up folks for failure, especially that are in a compromised position. And I'm not even talking about somebody who's like super, super subprime below 600. But those consumers in that 620, 640, 660 range, they're getting Credit Karma scores and like they're in the sevens. And you're talking like, no, you're not. And you're heavily scrutinized on the mortgage side. You're on the hook for hundreds of thousands of dollars for 30 years. So you're under the microscope a lot more than a free online resource like Credit Karma is offering. Um,
And that's even before explaining that there are nine different FICO scoring models.
there's
And
54. Yeah,
okay,
54.
I was
Yeah.
54. So nine I know of. So the
Yeah.
way I explain it is, when they're trying to figure out why are the numbers different, I'm like, hey, if you applied for a mortgage today and then applied for a car today and applied for, the Macy's credit card today, all three of us are going to give you a different score.
Yeah, you're right. Well, because
So,
obviously it comes down to the remarketability of the asset, right? I don't want to go too much
mhm.
in the weeds on this, but it's all these are risk-based mathematical equations on the likelihood of you paying back on this account. Here, this is a great example I always give. If you have a car loan, Dan, and you stop paying that car loan for 6 months, and you wake up one morning and you open your front door, what's not in your driveway anymore?
Hmm.
Your car. What happens if you stop paying on a credit card that you have open? You go to the grocery store one day, you're trying to buy groceries, and you run that credit card. It gets declined. A lot more difficult than when a consumer stops paying on their mortgage for a bank to get any sort of restitution on the outstanding payments. I mean, I've talked to people that haven't paid a mortgage. They've lived in their house for 10 years. Lights are still on. It's a whole different proceeds. So just really good information there.
Right, because
That
one, you already have the asset. One was able to prevent you from buying the potatoes.
Agreed.